what are transaction costs? They are the costs involved in the purchase and sale of shares and other financial assets. In the money market, we have the RBI, which will be an active participant, which is not there in the capital market. In the money market, the instruments are for a shorter duration, usually less than 1 year. Whenever the company is issuing shares for the very first time, that we call it as the new issue market. Hello everyone, I am Purnima, faculty in the Department of Commerce, Vidhyaashram Pre-University College, Temple of Excellence. In this session on financial market, I will be dealing with what is the meaning of the word capital market, and we will also be having a discussion on the difference between capital market and money market, and also the various types of instruments being traded in the capital market. Now, let us look into what is the meaning of the word capital market. The term capital market refers to facilities and institutional arrangements through which long-term funds, both debt and equity, are raised and invested. So, through the capital market, we can always raise long-term funds. So, long-term funds in the sense it can be both equity and debt. So, equity means it is the issue of shares and debentures. Through the issue of equity shares and preference shares, we will be able to raise long-term funds, and through the issue of debentures, we can raise the debt. Now, it consists of a series of channels through which savings of the community made available for industrial and commercial enterprises and for the public in general. Now, this capital market, it facilitates the flow of funds from the individual savers to the industry, or it is a means through which the savings of the community will be available for industrial and commercial enterprises. So, if we just save the money and put it in our cupboard, it will not give us any interest. Instead of that, we can always save our money in banks, which will give us a very minimal rate of interest. However, if you are very good in assessing the performance of companies, then we can always save money through this, or we can always invest money through shares and debentures, which can be purchased, and as a result of which we can get higher returns on our savings. Now, this facilitation is made with the help of capital market, or capital market is a place where we can issue shares and we can also issue the debentures to the public, and it will be usually a long-term fund of money. Now, next, an ideal capital market is one where finance is available at reasonable cost. Now, the process of economic development is facilitated by the existence of a well-functioning capital market. The capital market should also be efficient in respect of the information that it delivers, minimize the transaction cost, and allocate capital most productively. So, we should understand what is the meaning of the word capital market and also the nature of the ideal capital market. So, ideal capital market is one where finance is available at reasonable cost. So, whatever the sources of funds you are raising, so it should be available to the companies at very low prices, and the process of economic development is facilitated by the existence of a well-functioning capital market. Now, if you have a very good capital market, then it will be a cause for economic development of the country, because through the capital market only all the priority sectors will be functioning, or the government will encourage those priority sectors which are very essential for the economic development of the government. So, all the funding takes place through this capital market. The capital market should also be efficient in respect of the information that it delivers. So, it is the responsibility of the capital market to give proper information to the investors and also minimize transaction costs. So, whenever persons come to invest in the capital market, they should not be bogged down by the transaction cost. Now, what are transaction costs? They are the costs involved in the purchase and sale of shares and other financial assets. Now, these costs should be kept to the minimum level and also allocate capital most productively. So, whatever capital is being allocated, it should be put into the most productive sectors of the economy. So, capital market is one which facilitates the economic development of the country. Then, the capital market can be divided into two parts, that is the primary market and the secondary market. Now, what do we mean by primary market and what do we mean by secondary market? We will discuss it later on. Now, let us have a distinction between the capital market and the money market. Now, if you can look into the differences in the participants here, so first basis is the participants. The participants in the capital market are financial institutions, banks, corporate entities, foreign investors and ordinary retail investors from members of public. Now, we should understand that capital market is open for everyone, whether it is a financial institution, whether it is a bank, whether it is a corporate entity, foreign investors or individual investors, anybody can go and deal in the capital market. But in the money market, the participation is by and large undertaken by institutions, participants such as the RBI, banks, financial institutions and finance companies. Now, almost if you can see the participants here, both in the capital market and the money market, we have common participants, that is financial institutions, banks and corporate entities are there. But then in the capital market, we have an exclusive right. So, the members of the public are allowed to trade in the capital market. So, this is the main difference here. And in the money market, we have the RBI, which will be an active participant, which is not there in the capital market. Now, we should understand that almost all the banks, all the financial institutions and all the corporate sectors, they will be active participants in both the capital market and the money market. But in the capital market, we have the individual investors who can go and invest the money, and important aspect in the money market is RBI is active participant in the money market. Now, the next type of distinction between capital market and money market is the type of instruments. The main instruments traded in the capital market are equity shares, debentures, bonds, preference shares, etc. Now, in the capital market, we see some instruments like equity shares, preference shares, debentures, bonds, etc. So, in the capital market, any individual can go and purchase any of these instruments, or they are also called as the financial assets through which they can make their investments. The main instruments traded in the money market are short-term debt instruments such as the Treasury Bills, trade bills, reports, commercial papers and certificates of deposit. So, here if you can see here, we have the equity shares, preference shares, debentures, etc. But then in the money market, the instruments which are actively traded are the Treasury bills. Now, we know what is the meaning of Treasury bill. They are issued for a period of less than 1 year and they are usually issued by the government of India. It is maybe issued by the central government or the state government, and the RBI will be issuing, and it will be in the form of a promissory note. Now, these trade bills are issued. They are nothing but the commercial bills, and then we also have the commercial papers which are being introduced, and also the certificates of deposits which are issued by the banks. So, we have different types of instruments. for the capital market and the money market. So in the money market, if you can see, we have the Treasury bill and we have the trade bill, and then we have the commercial papers and certificate of deposits. Whereas in the capital market, we have the shares, we have the debentures, and then in the shares we have two types, that is equity shares and preference shares. Now we have a distinction between what are the various instruments being traded in the capital market and the money market. Now the next type of distinction between capital market and money market is the investment outlay. The investment in capital market, that is securities, does not necessarily require a huge financial outlay. So the value of units of securities is generally low, that is rupees 10, rupees 100, and so is the case with the minimum trading lot of shares, which is kept small, that is 5, 50, 100 or so. If you can just look into the investment outlay of the capital market, the investment outlay is very, very small. So anybody who has 10 rupees or who has 100 rupees, he can easily go and invest in the capital market. So the units of securities are kept very low because the members of the general public can easily go and invest in these funds. So the minimum trading lot of shares which is kept small, that is 5 rupees, 50 rupees, 100 or so. So this is within the reach of the common man. Whereas in case of a money market, it involves huge outlay of funds. So one treasury bill will be of a very huge amount, and then this cannot be traded by everyone. Only institutional participants can trade in the money market. Then the next distinction between capital market and money market is the duration. Now the capital market deals in medium and long term securities such as equity shares and debentures, whereas money market instruments have a maximum tenure of 1 year and may be even issued for a single day. Now we understand that capital market is a source of long term funds. It will be collecting money in the form of equity shares, preference shares, debentures, etc. that will be there in the company for a very long period. But in the money market, the instruments are for a shorter duration, usually less than 1 year. Now there are certain instruments which are issued even for 1 day. For example, the call money. So you can always avail this call money facilities which is availed by the interbank transactions whenever they have to maintain the cash reserve ratio. So money market is for a very short term funding and this is for long term funding. Then the next kind of distinction between capital and money market is liquidity. So the capital market securities are considered liquid investments because they are marketable in the stock exchanges. Money market instruments, on the other hand, enjoy higher degree of liquidity as there is a formal arrangement for this. The Discount Finance House of India has been established for specific objective of providing a ready market for money market instruments. Now let us look into the liquidity aspect of these investments. Now if you have the capital market securities, they are considered liquid because they are easily marketable in the stock exchanges. Now what do we mean by easily marketable in the stock exchanges? Any of these financial assets, it may be shares, debentures, etc., they can be easily sold in the stock exchange whenever the person is in need of money. However, for the money market, we have the Discount Finance House of India. So this Discount Finance House of India has been established and they will be ready to purchase the instruments from the money market. So any treasury bill or commercial paper bill or certificates of deposits, they can be surrendered to the Discount Finance House of India and we can always get it converted into cash, that is after the maturity period only. Then let us look into the distinction between capital market and money market on the basis of safety. Now, in the capital market, instruments are riskier both with respect to returns and principal repayment. Now, in the capital market, if anybody is investing there, then their investments are more riskier and with reference to the interest amount or the returns on the investment and also the actual capital amount which has been invested. Now, why we say it is more riskier? Because the companies may fail to perform as per the projections. Now, if it is a new company which has been floated and if it does not come up to the projections on which it has been raised, then the investors have the fear of losing their investment. They may not get their returns and they may also have to forego their money which they have invested in such companies. So, as such, the funds which are invested in the capital market are not very safe. But then in the money market, the instruments are comparatively safer because the persons who are guaranteeing this return on these funds is the government of India. So, the government of India will be issuing this money market instruments and it is an obligation on the government to honor its promises. So, we see that the money market instruments are much safer than the instruments of the capital market. Now, the last kind of distinction between capital and money market is the expected return. The investments in capital market generally yield a higher return for investors than the money market. The possibility of earning is higher if the securities are held for a longer duration. Now, we should understand that it is more profitable to invest in a capital market than in a money market. Why? Because there is a higher rate of return for the investors, and if you are holding the investment for a very long period, then the earnings also will be proportionately higher. Then why we have a higher rate of investment here? Because there is scope of earning capital gains in equity shares. So, this is the first reason, that is we have the scope of earning capital gains, that is the share prices may go higher and higher when there are more profits, as a result of which we may have some capital gains in the long run. And secondly, the prosperity of the company is shared by along with the shareholders by way of high dividends and bonus issues. Now, first thing is the scope of earning is higher because of capital gains, and secondly, if the company is always giving dividends to its shareholders, the share prices will go higher and higher, as a result of which the company may also give bonus issue to its shareholders, and all this will have a bearing on the return of the investment. So, as a result of which the capital markets are more profitable than the money market. Now, next let us look into what do we mean by primary market. So, the primary market is also known as the new issues market. It deals with new securities being issued for the first time. Now, we know that primary market is also known as the new issues market. Now, what do you mean by new issue? Whenever the company is issuing shares for the very first time, that we call it as the new issue market, or we also call it as the IPO, or we call it as the initial public offer. So, whenever the company is issuing shares for the very first time, it will be always in the primary market, or it is also called as the new issues market. Now, the essential function of the primary market is to facilitate the transfer of investable funds from savers to entrepreneurs seeking to establish new enterprises or to expand existing ones through the issue of securities for the first time. So, whenever you have a primary market, it is to facilitate the transfer of investable funds from savers to entrepreneurs. So, we are transferring funds from the individual savers to the entrepreneurs to see that they establish new enterprises or expand the existing ones. Now, the investors in this market are banks, financial institutions, insurance companies, mutual funds and individuals. So, anybody can invest in the primary market. Usually, the major players are the banks, insurance companies, mutual funds and individuals. So, individuals also can invest in the primary market by purchasing the initial public offer made by the corporate houses. Then, a company can raise capital through the primary market in the form of equity shares, preference shares, debentures, loans and deposits. So, in the primary market, the company can raise long-term funds by issuing equity shares, preference shares, debentures, loans and deposits. The funds may be for setting up new projects, expansion, diversification, modernization of existing projects, mergers and takeovers. So, whenever the company is issuing shares for the very first time, it will be in the primary market, and the purpose for which the shares are issued are usually for new projects. So, if the company is engaged in a new project, it wants money for a new project, then it will issue shares in the primary market, or for expansion, or it wants to open a new branch. Then diversification, that is, it wants to go in for a new product line, or modernization, so it wants to upgrade its technology, mergers, so it wants to take over another company. For all these reasons, the company can issue shares in the primary market. Then next is, what are the different methods of flotation of shares? So, whenever the company issues shares and debentures to the public, it has to incur a cost called as the flotation cost. Now, let us look into what are the various methods of flotation of shares and debentures. Now, the first method of issue of shares is offer through the prospectus. Now, offer through prospectus is the most popular method of raising funds by public companies in the primary market. Now, this involves inviting subscription from the public through the issue of prospectus. It makes a direct appeal to investors to raise capital through an advertisement in newspapers or magazines. Now, you can always issue shares or debentures by the help of prospectus. Now, what do we mean by a prospectus? It is a direct appeal. So, you just directly appeal to the public to invest in the company shares and debentures, and it will be usually done through by giving an ad in the newspaper and other magazines. So, any company which wants to issue shares, it can always issue a prospectus. It will be in the form of an advertisement, and it will invite the public to subscribe for the shares and debentures. The next method of flotation is offer for sale. So, under this method, the securities are not issued directly to the public, but are offered for sale through intermediaries like issuing houses or stock brokers. Now, in the first instance, in the issue of prospectus, the company will be directly inviting the public to invest in the company shares and debentures. But then, in the second method of flotation, we have the offer for sale. Now, in this offer for sale, the securities are not issued directly to the public, but it will be issued through banks or through underwriters or through the stock brokers. So, anybody who wants to invest, he or she can always contact it through a stock broker and purchase those shares. Now, the third method of flotation is private placement. Now, what do we mean by private placement? Private placement is the allotment of securities by a company to to institutional investors and some selected individuals. It helps to raise capital more quickly than a capital issue. Now, the third method of flotation of shares is private placement. Now, here the company will allot the securities to an institutional investor. So, institutional investor is all those companies which are ready to invest. So, through this private placement, the company will issue a large part of its share to this institutional investors or to some selected individuals. So, this is a much cheaper method of raising funds than raising it through the public issue. Then, the fourth method of flotation is the rights issue. It is a privilege given to the existing shareholders to subscribe to a new issue of shares according to the terms and conditions of the company. The shareholders are offered the right to buy new shares in proportion to the number of shares they already possess. Now, what do we mean by this rights issue? So, the rights issue refers to the right given to the existing shareholders. So, for the existing shareholders, the company sets aside a certain portion of the shares which is called as the rights issue, and these existing shareholders are given in proportion of the holding which they already have in the company. Suppose the person is having 4 shares. Through the rights issue, he may be given another 4 shares as rights issue. So, it is offered for the existing shareholders as a preferential right. Then, the next method of flotation is through EIPOs. A company proposing to issue capital to the public through the online system of stock exchange has to enter into an agreement with the stock exchange. So, this is called as initial public offer. So, electronic IPOs, electronic initial public offer. Now, almost all the stock trading is going in the stock exchange goes on through the internet, and whenever a new company is issuing shares to the public, it has to enter into an agreement with the stock exchange, and this agreement we call it as the EIPO or the initial public offer. These are the various methods in which there are flotation of the various instruments of the capital market is done. Hope you have all understood this session on capital market. Thank you.